What's up, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to take a look at Big Lots stock, ticker BIG. This is a rare opportunity where the stock is trading at a valuation that's below its book value or its equity value. And if you know anything about Warren Buffett and Benjamin Graham, you know that back in the 1950s, one of Benjamin Graham's methods that he taught was finding a stock that is trading below its book value. And so we don't really see that too much in the stock market anymore. In the last 6 years or so that I've been investing, I think I've only seen one or two other examples where this was the case. And I remember I did buy into that stock and I did make some money in a relatively short period of time. So hopefully this stock is a similar opportunity. So if we take a look at the stock price here, we're going to see it's about $15 a share. Its market cap is $430 million. And if you don't know, Big Lots is a discount retailer. They sell a wide variety of things, but a third of their business is furniture, and then the other categories are, decorations or clothes or electronics, whatever. So that's the first thing to take a look at here. And if you see the stock chart, you can see it's down 73% in the last 5 years. In their most recent, their earnings, they put out a earnings presentation a couple days ago, and it looks like they lost their biggest vendor for their furniture business. And they said that their numbers still came in line with expectations, though. But that is why we're seeing the stock fall so much. It's down, 17% in the last couple months, I believe. Let's see, in the last year, it's down 59%. So things have not been going good for this company. They have like 1,400 locations and they're in about 48 different states. And so we're going to do some analysis and see if this is a good stock to buy right now. If we take a look at, let's start with revenue. So revenue, they've done a good job growing revenue. Only on average, they grow it at about 1 or 2%, but they still did $6.1 billion of revenue. We're talking about a company that's trading at $400 million right now. For net income, you can see it's not great. It doesn't really... Not much steady improvement there, not much consistency, but we can see that over the last 10 to 15 years, they're pretty much doing 150 up to $200 million of net income. So their average net income over the last decade has been, or it is, half of their market capitalization right now. So that means, you could buy this company right now and there's a good chance in the next 2 years it would pay itself off. So that's an interesting way to look at it. And so that's why our first one here, our first thing's going to get a check. Our second one is not, because it's not really improving. Then we look at their price to earnings. This one is a bit, how do I put it? It's hard to evaluate this accurately because, okay, for the last decade, this stock traded a P/E ratio of about 10 times earnings, right? So just right off the bat, let's just do this. We know that they're doing, let's just be conservative and say over the last decade, they averaged about $150 million of net income, like we just saw. On average, they're trading at a 10 times multiple, which means this company should be $1.5 billion. That's being conservative, and that's using the last decade of numbers as our analysis. So I don't see why this company couldn't be a $1.5 billion company. But if we look at the last 3 years, we're going to see its P/E ratio has been all the way down to a 2 and up to about a 7. So not the best scenario. Now in this last 12 months, you're going to see here they were losing money, right? They lost 12 million last quarter, up to 100 million the prior quarter, and they lost over $200 million last year. But in the years prior, again, they're doing 177, 240 million, and then they had this outlier year with $600 million of net income. So think about it. If you're paying $400 million for this, that's a pretty good deal. Keep in mind, they have positive equity on this as well. They have over $700 million of equity. Now, we're going to get into that in a minute because I'm going to break down why I would probably lower that number in my estimates. But the bottom line is you're getting a large amount of equity and a company that is normally doing $200 million a year of net income, and you're only paying $400 million. So right, that just looks like a good deal to me. I'm not saying this is a financially strong company, and I'm not saying this is some great business, but just looking at those metrics, it is interesting. Now, right now, they're trading at 14 times earnings for this year. They're expected to do a little over $1 of EPS, and it's a $15 stock. So roughly 14, 15 times earnings. But keep in mind how we just did 10 times 150 or $200 million. This could be a $2 billion company pretty easily. This could go up, 4x from where it is today. I think there's a good chance that happens. Are they innovative? Do they have a moat? No, I don't see that in any way. Is the industry growing? Yes. Discount retailers are growing. The industry grows at 5% per year. That's what it's expected to do. Return on invested capital. Here's another sign that this is a strong company. I was very surprised by this. Return on invested capital has gone all the way up to 33%. There's been, in recent years, it's gone up to 28%. Last year, they did only 9%, but that's still better than a lot of other companies. And that's on the extremely low end. So we can expect a 15 to 20, upwards of 20% return for this company, which is very strong. So that gets a check. Increasing free cash flow, unfortunately not. You can see here it's not very stagnant, it's not very consistent. And since 2007, it peaked at 340 million. Last year it was only 30 million. And probably 70 to 100 million is a more realistic number. So once again, not the best numbers there. That's going to get a no. Diverse revenue streams. Yes, I put yes because how I said they sell furniture, they sell apparel, decorations, all this different stuff, and they're in 48 different states, so that's pretty diverse. Now, real quick, okay, we're going to save their latest presentation for the end. Growing equity, no. If we look at equity here, we are going to see that it's gone from $1 billion to now 780. That is decreasing. Is the equity over 15%? Yes, it's 200% plus of the market cap. Share count decrease. This is another great sign. We're also going to talk about this at the end because this is another strong catalyst pushing the stock. Look at where it was in 2004, 115 million shares. Now we're down to 30 million shares. So we're talking, they average a 7% decrease in the number of shares per year. That's a good sign. That means they're buying back the stock, taking shares off the market. Are assets 2 times liabilities? No, not exactly. 4 billion of assets, 3.2 in liabilities. And profit margin over 10%? No, I think it's like 3%. It's very low. This is a low margin business. They're a discounted retailer. Cash more than income? No. Dividend, I put yes. Now, this is another interesting factor here. The dividend yield is up to 8% right now. Okay. Now, of course, that's not healthy. So they're doing 30 cents of a dividend per share per quarter. So that equates to $1.20 of dividends per share. So, of course, that's not healthy when you're losing $200 million in last year. But remember, they normally do $200 million. And if you look at the cash flow statement, you can see it only cost them about, I believe, $30 million or $40 million when they're normally doing like $200 million. So watch, if we come here, we're going to see cash dividends paid 30 to 40, maybe $50 million. And they're normally doing $200, $300 million of net income, right? So that's not bad at all. That's like a 20% payout ratio. That's not bad at all. That's definitely healthy. I'm not saying this 8% can stick around forever. I mean, I think the stock price is going to probably come up and probably double, and that's going to become a 4% dividend yield. Or if they cut it, that's fine too. That's totally fine because they could reinvest the cash, help build up the equity in the business. I'm totally fine with that. It's also a cushion. It means it goes X dividend in the next couple of weeks. So if I buy the stock now and it drops 8%, well, I'm getting paid an 8% dividend this year anyway. So it's also a little bit of a cushion there. Over 20 years old, yes. I think from the 60s, yes. As you can see, I do have a limit buy already queued up for tomorrow when the market opens. I do have some shares already queued up. But let's get into the interesting part. So overall, it gets a 9 out of 16. It does not complete my checklist as a buy, but I still plan on buying it at the moment. So here's the interesting part. Let's go to, well, first we're going to take a look at, this is the only corporation or only hedge fund I see buying this. Last quarter, they bought let's see, about over almost $500,000. Let's see, that's got to be that's $400 million or so they bought worth last quarter. So that's one positive sign. But here's the interesting thing. Okay. here's in their most recent publication. So they talk about the dividend, blah, 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 blah. Talk about their balance sheet, 44 million in cash, 300 million of long-term debt. I know that's not good. We're going to get into let's get into their balance sheet right now. So balance sheet. Okay. So yes, it is trading at a market cap of 430 million, equity 780 million, right? But here's the things. Let's say this company is going out of business, right? Let's say they're selling everything. Well, something's going on out there. Well, okay, so let's say they sell let's say they sell all their properties, right? They're going to get $2.5 billion roughly. Could be a little bit less, could be a little bit more. Who knows? The real estate market is up in the air right now. Cash is not strong. They're not in a strong. We're talking they have over $3 billion of liabilities and only 60 million in cash. Now they do have 1.3 billion in inventory, but I think I wouldn't count that as 1.3 billion. That's tough because what do you see happen when these companies like Sears are going under? They put everything at 50, 60, 70% off sometimes. So I think like $500 million. If we want to be safe and be conservative, I would say they only have $500 million of inventory. If we're talking they're going out of business, if they're selling off inventory as a last minute thing to stack up cash and all that, then I'm looking at this like 500. Okay. So we're going to take off. We're going to say they have like 700, 800 million current assets. Plus this equals 3.3 billion. Okay, so that's going to take care of liabilities. So we're talking maybe they have $100 million of equity left or something, right? And I think they're going to have positive net income for 2020 for this upcoming year. I don't see why not. So, I mean, we're talking, but now if it comes out to that 100 or $200 million is playing it safe. If we're talking, if these numbers are accurate and let's say they're not going out of business or they have to sell off inventory and it is close to 700 million, well, then there you go. You're getting nearly $700 million of equity for only 400 million. But I don't think they're going out of business. I don't know how realistic that is. So I don't know. I don't see that as a realistic thing happening. It's possible, of course, but I just see like the risk to reward is pretty attractive here. I think there's a good, I mean, we're looking at it, it's at the bottom right now. Like there's a good chance this becomes a $30, $40 stock again. And that's kind of what I'm betting on here. But here's the best part of this, okay? $159 million share buyback is coming to Big Lots over the next 12 months, okay? That's 36% of the current market cap, which means this stock's going to go up 36% as they buy back all these shares. There's also an 8% dividend yield. So we're talking 44% we're going to get from this stock over the next year. This stock would have to go down 44% for me to break even, pretty much. So, and they also said they're expecting within this next upcoming quarter, they're expecting an 11% decrease in the share count. That means this stock is going to go up 11%. And that they just said that in the last couple of days. That was a couple of days ago. So once again, the risk to reward is pretty attractive here. So I think I'm going to take a chance with this one and buy it and see what happens. But yeah, I mean, I'm curious to see what your guys' thoughts are. I know a lot of people are going to say this is probably a junk stock, and you might be right. Maybe this very well could be a $7 stock 6 months from now. But I think there's a equal or if not a better chance that it's a $30 stock or $40 stock 6 months from now. Because they've shown for over a decade now they can do $150, $200 million of profit in a year, no problem. They've done it for a decade. So yes, this past year, as with a lot of other companies, maybe they're still suffering from supply chain and inflation issues, and this is a one-time thing where they lose money. But I think that they're going to get back to profitability. I don't see why not. Yes, they lost their biggest furniture vendor, like they said in the news that came out last week. But that doesn't mean it's the end of the world. Like, is that a third of their business gone? Maybe, or close to a third. Maybe it's a fourth or something. But maybe they can get a new vendor. I mean, that doesn't mean that it's the end of the world for them. So that's the way I'm looking at it. I'm curious to see what your guys' thoughts are. I think there's a lot of catalyst, a lot of momentum for a company like this with an 8% dividend yield, and that share buyback is very convincing. I like to see companies issue big share buybacks like that. So if they're buying back shares, it's priced for, the stock is priced for bankruptcy almost pretty much right now. So I'll take my chance. I'll buy the entire company for $400 million, who normally is doing $200 million and has $200 million a year of profit and over $700 million in equity on the balance sheet. I'll take my chances with that, and we'll see what happens. So thank you for watching. I will